Most traders trade options simplistically, but by employing smarter tweaks to your entries and exits, you can make a lot more profit efficiently, and that's exactly what you're going to learn in this video. I'm Seth Freiberg, and we're one of the top proprietary trading firms in the world with numerous 7 and even 8-figure per year traders. You found the right place to learn. So there are tons of traders out there who supplement their income by selling put options on stocks that they're willing to own at the strike price of the put they're selling, a strategy known as cash secured put selling. And they can rack up very significant additional cash income by doing that each month. But there's a problem, and that problem is that most traders who do this are leaving a very large amount of money on the table because they aren't thinking like professional options traders who employ a very easy to understand tweak to this trading strategy that is so obvious that you'll kick yourself once you realize it, and you'll never trade cash secured puts the same again once you understand this one simple principle. So if that sounds of interest to you, then stick around, because this could really greatly increase your cash income from selling cash secured puts each month. Before we get into the simple tweak that we're going to be teaching you in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategy that we're going to be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. Let's jump in and take a look at an example of how this works. So there is a stock with the ticker symbol TLT, which is an ETF that's based on the 20-year and above United States Treasury bond. And it's a popular ETF because it yields monthly income and its price moves similarly to how long-term bonds move. And so let's head back to December 20th of last year, 2024. And take a look at a price chart of TLT. And as you can see, after rallying from its April lows, TLT began to sell off in the fourth quarter, closing near its lows of the year at 88.31 on December 20th, which is the third Friday of the month. And that's significant because essentially all options reliably have at a minimum, an options chain that expires on the third Friday of each month. So that if you're planning to run a campaign strategy where you make the same basic trade every month to collect cash, you'll know that there will always be an expiration available once a month on the third Friday of each month. And so let's say that at the close that day, you pulled up an options chain expiring 28 days later, which is the third Friday in January, and you looked for that column called Delta, which is a column that every options trading platform will provide you with. And you find a put option with a delta of about 30, which in this case is the 87 put strike price. And you sell 10 of those for 76 cents. And while an options delta is a mathematically arrived at prediction of how much an option will move based on how much the stock moves, it also can be used to roughly predict the chances of the stock, in this case TLT, expiring below 87 on expiration day. And that's to say that TLT has statistically a roughly 30% chance of expiring below 87 on the third Friday in January, which means that obviously it has a roughly 70% chance of expiring above 87, in which case the 30 delta put option will expire worthless. So why in the world would we want to trade something that has a 70% chance of expiring worthless? Well, let's take a look at that. You see, when you sell a cash secured put, you receive cash. And in this case, you received the price of 76 cents for selling these 10 cash secured puts. And remember that you'll be obligated to buy 100 shares of stock for each put option you sell if the stock closes below 87 on expiration day. So you multiply that price by 100 and you sold 10 of them. And so when you multiply it all together, you'll collect $760 in your account as soon as you enter into this trade. And please note that you'll need $87,000 in your account in cash should the stock close below 87, in which case you'd be required to buy 1,000 shares of the stock at 87 per share, as you can see from these calculations. And so now it should be more clear to you why we'd like to sell the 30 delta put, because we received cash. and we'd be very happy for that put to expire worthless, and we just get to keep the cash. And in fact, that's exactly what happened, because if we move forward to January 17th, the day these 10 put options expired, and as it turned out, TLT had actually fallen below 87 briefly during the duration of the trade, but it rallied strongly and closed at 87.19 on the day the trade expired. And so what that means is that the put options expire worthless, because remember, they only have value if the stock closes below 87, because then at that point, the owner of the put can acquire the shares for cheaper than they're trading in the open market. But if the stock is trading higher than 87, then the put just expires worthless, which is what happened exactly in this case. And that outcome is fine with you, because you then just get to pocket the $760 you collected initially. So in a campaign like this, just rinse and repeat. So we'll move on to the third Friday in February, which in this case is the 21st of February. And as you can see, the closest put to at least 30 deltas is the 86 put, which is selling for $1.03. And so just like before, the calculation would show that we'll receive $1,030 for entering into this trade and moving to the day that those put options expired. You'll see that the stock had generally moved bullishly since we initiated the trade on January 17th, and by February 21st had reached $89.61 at the close. And so again, the puts expire worthless with the stock closing $3.61 above the 86 put strike price. And so again, we pocket the $1,030 in put premium and move on to the March trade, where this time we sell the 88 put, which is nearly 30 deltas for 65 cents in this case, bringing in $650. And moving finally to March 21st, the third Friday in March, we can see the stock was generally a little bit bullish and closed at 90.70 on the day the puts expired, meaning again, the stock closed above the put strike price, resulting in yet another win of $650 for this trade. And so the 3-month campaign produced a profit of $2,440. Okay, so that would be what options traders would refer to as a set it and forget it trade, where you'd either just pocket the full initial options premium you received, or you get assigned the shares of TLT and you then own 1,000 shares of TLT. And that's okay, but that in no way is how a professional options trader would handle the strategy. And now we're getting to the core lesson of this video. And that is that professional options traders actually very rarely allow cash secured put trades to just expire. And the reason for that is very simple. And that is, if you think about it, when you sell a cash secured put, the maximum you can make on the trade is the initial cash flow you receive, because the biggest win on a cash secured put trade is if the puts you sold expire worthless. But what if the stock rallies very early in the trade? Well, in that case, very frequently, the puts can lose half or more of their value very, very early in the trade, meaning that if instead of allowing the puts to expire, we buy them back early in the trade, which closes the trade, locking in a lesser amount of profit, but getting that profit much quicker than waiting until expiration. If we do so according to a careful approach that takes in consideration how much profit you've earned and how long it's taken for you to earn it, you'll be surprised how much you can improve your positive cash flow and profit. And so the idea is that once you've taken the smaller but much quicker profit, you can then immediately start a new trade and reload with a full premium instead of waiting around, allowing your capital to languish while you wait for the rest of the profit to come into the trade at a much more slow pace. Doing so maximizes your capital utilization instead of allowing your capital to be stuck in a trade where a win is almost inevitable. But the needle towards that win is barely moving every day because you've earned so much of the profit already. And so, for example, a common approach is to take the duration of the trade and split it up into quartiles, such that on a 1-month trade, for example, if the trade got up 50% of its maximum 100% profit, which is the original cash flow, in the first week, then you'd close it for a profit of 50% of the cash flow. and immediately start a new trade. If that doesn't happen, but the put shrinks to 40% of its original price in the second week, then you take it off for a 60% profit, and so forth for the third and fourth week, as you can see from the matrix. The whole idea is to take profits quickly if the quick profits appear, and then redeploy your capital immediately, getting your capital going again on a full profit potential trade as quickly as possible. And so let's take a look at how this same 3-month period would have played out using that approach. So starting with the first trade, you'll recall that TLT was trading at 88.31, and we sold the 87 puts for 76 cents, collecting $760. Well, as it turns out, on this very first trade in this new campaign we'll be doing, the trade never got to 50% profit in the first week, 60% profit in the second week, and so on. Instead, we had to literally wait until the morning of the expiration when the trade finally got down to 10% of its original price, and thus we could take it off for a 90% profit in the fourth week, which we did, paying 6 cents to buy it back for a profit of $700. So let's start keeping track of this in a scorecard, and we'll be keeping track not just of our profits, but the stage the trade was in when we took it off, so you can see this in action and how we use that profit matrix that we just showed you. Immediately, we start a new trade with TLT trading at 87.42 using the 86 puts, this time, again, the 30 delta puts priced at 86 cents, therefore collecting $860. And so if we move forward 12 days to January 29th, you can see that TLT had rallied a bit, and during this time, the second week of the trade, the put is now trading at 34 cents, which is 40% of the original price of 86 cents, and therefore meets our 60% profit requirement for that second week. So we pay the 34 cents, buy back the puts, and the result is a $520 profit, as you can see, which we're going to add to our scorecard. And so we're not even out of January yet, and we've already finished 2 trades, and now we're moving immediately to our third trade, which again expires a month later on February 28th, and this time we're selling the 87 puts, the 30 delta calls, and the price again happens to be 86 cents, bringing in $860 of positive cash flow again. But this time we only have to wait a week, which is important because in the first week, we can close the trade with a profit of 50%, whereas later in the trade, we demand more profit. And so this morning of February 5th, the TLT opens up $1.03, which is a lot for the TLT. And as you can see, the puts price has dropped to 35 cents, which is actually less than 50% of the original price of 86 cents. And so we can close the trade for a profit of $5.10, which is more than 50% the first week, and therefore meets our objective of a 50% profit if the trade can be closed within a week. So we'll update our scorecard accordingly. And so I think you're probably by now getting the hang of it. We're simply following our profit requirements based upon time in trade, with the idea that if we can grab an early profit and reload with a full additional premium, we're going to do that. Not wait for an obvious winner to very, very slowly, boringly grow its profit every day, when in fact the profit remaining to capture in the trade just isn't worth keeping our capital tied up. And so we won't go through every remaining example, but I can tell you, if you had continued the campaign in this manner, this last trade would have been followed by a March 7th trade, which was a slower trade and didn't close until the third week, and therefore required a minimum profit of 75% of the original cash flow, which we exceeded by closing the trade at a profit of $700. The fifth trade was entered in early March, the March 28th trade, and we received $680 for that one, and we were able to close it within the week, thereby triggering our 50% minimum requirement for a win of $370. And finally, we intentionally cut short our final trade, the April 4th trade. We cut it to March 21st so that we were trading the exact same period of time as the unmanaged technique that we first showed you in this video, where the options are just permitted to expire on their own. And so this final trade was kind of a truncated trade, and we made just $250 on that. And so the full professionally managed campaign results in a final profit of $3,050. And so as you can see, the comparison is pretty strong, making 25% more on the managed approach than the unmanaged approach. And yes, it's more work, but if you're going to be a professional trader, there's going to be some work involved. But as you can see, there's a handsome reward for your additional efforts. And so what I'd like you to take away from today's video is that options selling strategies can be enhanced greatly by using some common sense and realizing that there's a cap on how much you can make on any option selling strategy. If you've reached a really good portion of that maximum profit quickly, it's almost always a good idea to close the trade, book your profits, and move on to redeploying your capital in a way that maximizes the use of your capital. Don't be lazy and allow your capital to languish in a trade. Let me say that again. Don't be lazy and allow your capital to languish in a trade where it's pretty much a foregone conclusion that you're going to win, because usually the remaining reward simply doesn't justify your tying up your capital any longer in that trade. Once you learn how to think this way as an options trader, you can put a permanent boost in your returns, which is exciting and can be done by independent traders just as effectively as professional traders do.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.